Let's discuss how the U.S. China trade tensions are reshaping the world of technology. We have seen the latest tariffs expected this month, delayed until December. How much more leeway does this give companies for them to stockpile on supplies?
Yeah. Well, thank you for having me. I think that it gives them fairly significant leeway, and I think that we've seen this over and over and over. So the impact of the tariffs had, very little impact on overall IT demand in 2018, and as we've gone into 2019, it's also really not had a significant impact. Now, where it has had an impact is in areas, say, like personal computers. Last quarter, personal computers, we actually saw some single-digit growth in that market, and that's because of some of the stockpiling that we saw. And what we found is that the U.S. list of products that would be affected by tariffs has been very, very cleverly constructed. It's been constructed not to include things like smartphones yet, not to include things like PCs yet. And that means that we're seeing consumers and enterprises buying ahead of potential tariff impact, which has actually had a positive impact. Now, of course, if the tariffs do go into effect later this year, that would have an impact going into 2020. But right now, we haven't seen a huge impact.
How flexible are supply chains at the moment, and will it have an impact, these trade tensions, on IT budgets?
Yeah. So supply chains are not that flexible, but there's been some time to adjust. So we've seen some manufacturers be able to start to adjust production and where they actually do final assembly of product. But the reality is that going forward, this could affect overall demand, and the overall supply chain can only take so much. So, for example, we're looking at somewhere around 3.5% to 4% IT growth, overall IT spending growth for sort of traditional products in this year, 2019. If we were to go to a tariff escalation scenario, which is kind of where we are today, we think that could take maybe a 0.5 point of growth off overall demand by the end of this year. And then going into 2020, if we did kick tariffs up, you could see a point, maybe 2 points reduction in overall IT spending as the market would just slow and you wouldn't see that sell through of products going forward.
Crawford, if we did have a upbeat, at least phase one mini deal resolution to the trade tensions, and markets and investors are feeling pretty good about things over the next few months, how quickly does it take to unwind the damage that's been done sentiment-wise when it comes to capex spend and investment?
I don't think it would take much, and I think that would happen relatively rapidly. I think what you would see is that companies would continue to spend or would be fairly resilient in terms of their spending, and in that scenario, I think we would continue to see maybe a 0.5 point increase in overall IT spending, something in that 3.5% to 4.5% band. Again, I think that overall enterprises and their spending have not been that significantly affected. So I think that their ability to say, okay, you know what, coast is clear, we're going to continue to spend, I think it would be more of a steady as the market goes. I don't think you would see a major snap back because the impact hasn't been that strong yet.
In terms of the negotiations, the many rounds of talks for this trade war, technology has really been placed in the too hard basket, right? Because it's largely seen as this strategic competition between China and the US, the two superpowers. Do you see a meaningful compromise possible, or is it that we are really looking at this, kind of existential split between a world of technology that's created by China and then the US?
Yeah, I think going forward, it really comes down to what technology you're talking about. For example, I think that when you look at how overall technology is developed, core microprocessor technology and the demand for those kinds of products, I think that those will not be as significantly affected. Now, if you look at Chinese demand for products going forward, what we see is that the Chinese demand for products tends to be much more hardware centric, and Chinese markets tend to be much more hardware centric. They tend to purchase things like classic personal computers, servers, enterprise infrastructure. infrastructure and those products. So far, rhetoric aside, we've continued to see Chinese demand for those products be relatively strong. Now, for emerging technologies, China tends to be very, very strong in things like AI, things like robotics, things like augmented and virtual reality. Interestingly, the Chinese economy doesn't spend as much on things like enterprise software, and there aren't as many indigenous products for enterprise software there. So I think that over time, what we'll see is that China will continue to be relatively hardware-centric and will, continue to buy the same kinds of products that we buy in the Western world. Where it will change is things like what your last guest was talking about, areas like potentially 5G, where there you could see, different suppliers supplying 5G technology into the Chinese economy versus other economies. So there you see Huawei selling potentially a lot locally, whereas outside of areas where Huawei does business, you would see a benefit to companies like Ericsson and companies like Nokia for 5G infrastructure. But I think that overall, where we're likely headed here is some kind of a deal where we see a market much like the market we've seen in the past, where everyone's competing on sort of the same traditional markets.